Okay, hi everybody. I am doing this recorded lecture for chapter 20 of our intermediate accounting textbook. As we're going to see, chapter 20 is about accounting for pensions and post-retirement benefits. And so we'll go through and look at some examples in the PowerPoints and then of course get practice with it in class together. So I am going to share my screen with you and get the PowerPoint pulled up. So chapter 20, again, we're looking at accounting for pensions and post-retirement benefits. So after retirement benefits. And so some of the main learning objectives of this chapter: understand the fundamentals of pension plan accounting, use a worksheet for employers' pension plan entries, describe the accounting and amortization of prior service costs, explain the accounting and amortization for unexpected gains and losses, and then describe the requirements for reporting pension plans in the financial statements. And so pension plan accounting, when we think about pension plans and they've definitely changed over the years. It used to be that a lot of different companies offered pension plans, and some still do. Like I know my husband works in, basically he's a union floor layer, so he works in the carpenters union, and they still have a pension. I know, for example, like Boeing used to have a pension, and then they like switched it over to like a 401k plan. And so we're going to talk about some of the differences between those, but basically like a 401k is like a defined contribution plan where you make contributions, and depending on how much you make in contributions is how much you're going to have at retirement type deal. Where a defined benefit plan is more like a pension plan where you pay into it throughout your working life, basically, with the company, and then they give you X amount. So it's a defined benefit. They give you X amount at retirement. And so we're going to kind of look at the differences between those, and again, the entries and how we calculate and how we record some of these. So a pension plan is an arrangement whereby an employer provides benefits or payments to retired employees for services they provided in their working years. So the employer makes the contributions into a pension plan administrator, like we see here, right? And then once the employees retire, and this pension plan is going to be made up of assets and liabilities, right? So assets from the money that's paid in by the employer, and liabilities from what is actually due to the employees or the pension obligation. And then once that employee retires, again, those benefit payments go to the employees. So that's what we're going to be looking at overall here. And so just like it tells us in the book, pension plans can be contributory. Employees voluntarily make payments to increase their benefits. This would be the example of the 401k that I gave you. Non-contributory, the employer bears the entire cost of the pension. And then qualified pension plans. And so qualified pension plans permit deductibility of the employer's contributions to the pension fund and tax-free status of earnings from pension fund assets. So just like it shows here, the pension fund should be a separate legal and accounting entity. The pension fund as a separate entity maintains a set of books and prepares financial statements, maintaining records and preparing financial statements for the fund, accounting for employee benefit plans, and again, and I'm looking at page 1118 here. But the basically employee benefit plan, or the separate entity that's keeping the accounting or doing the accounting for the employee benefit plan is essentially reporting to the employer, who is the sponsor of the benefit plan. Okay, so we talked about the difference between these two: defined contribution plan or defined benefit plan. So defined contribution plan, the employer contributes a determined amount to the plan. The risk is basically borne by the employees or on the employees, and benefits are based on the plan value. So how much is contributed to the plan. Whereas a defined, and again, the example of this would be like a 401k if it's a for-profit entity, or a 403b if it's a non-profit entity. And then the defined benefit plan, benefits determined by the plan, employer contributes, contribution varies, risk borne by the employer. This would be like a traditional pension plan. You get a defined amount at retirement. And so determined by actuaries, actuaries make predictions called actuarial assumptions of mortality rates, employee turnover, interest and earnings rates, early retirement frequency, future salaries, and any other factors that may impact or any other factors that are necessary to operate the pension plan. So 2 questions that we have to ask to measure the liability. What is the pension plan obligation that the company should report in the financial statements? And what is the pension plan expense for the period? So again, we're going to be looking at examples of both of these and get some practice with these, of course, in class together. All right, so measures of liability. So employer's pension obligation is the deferred compensation obligation it has to its employees for their service under the terms of the pension plan. And so again, just like your book tells us, there's a few different ways that this can be calculated. So, generally speaking, it's based on the present value of the expected cash flows computed by actuaries. And we can look at it, the first way is vested benefit obligation. So benefits for vested employees only at current salaries. We can look at it according to the accumulated benefit obligation, which are the benefits for non-vested employees at current salaries. Or as it shows here, the FASB prefers us to use the projected benefit obligation, which is the benefits for vested and non-vested employees at future salaries. So, again, when we think about the vested benefit obligation, this is current salaries. When we think about the accumulated benefit obligation, this is current salaries, right? But using future salaries is a better determination because they're going to be paid benefits or pension based on their future salaries. All right, so measures of the liability: recognition of the net funded status of the pension plan. Companies must recognize on their balance sheet the full overfunded or underfunded status of their defined benefit pension plan. The overfunded or underfunded status is measured as the difference between the fair value of the plan assets and the projected benefit obligation. And as we're going to see as we go through here, it says net funded, which would lead us to believe, okay, if we have, plan assets, we're going to subtract plan liabilities or plan obligations, plan liabilities, whatever. And that's going to give us the net amount. But just like it tells us in the book that we cannot net the assets and the liabilities. Basically, we net plan assets. So if we've got a couple different retirement plans, and maybe one retirement plan has 100,000 in assets, and maybe the other plan has 50,000 in assets, then that's a net amount of 150,000 plan assets type deal. And then we net plan obligations. And so again, if we have two different retirement or two different pension obligations, maybe one obligation's 100,000, maybe the other obligation is 50,000, then we've got net 150,000. So that net doesn't mean we're netting the difference between assets and obligations or assets and liabilities. We can net the assets, we can net the liabilities, if that makes sense. But again, we'll see that later in the chapter, and then of course get some more practice with it in class together. All right, so here are some of the different factors that can impact our pension expense. And we're going to go through on the next few slides each of these individually, but service cost for the year, this increases pension expense. Interest on the liability, of course, also increases the pension expense. Actual return on the plan assets. So this would be like the interest revenue from the money, monies invested. And so generally that decreases the pension expense. Amortization of prior service costs, that increases pension expense. And then gain or loss can either decrease or increase pension expense. So again, we're going to look at examples of those and of course get practice with them in class together. But the service costs, actuarial present value of benefits attributed by the pension benefit formula to employee service during the period. And again, this has usually increases the effect of the pension expense. Interest on the liability, interest for the period on the projected benefit obligation outstanding during the period. The interest rate is used is referred to as the settlement rate. Again, that increases pension expense. Actual return on the plan assets, increase in pension funds from interest dividends and realized and unrealized changes in the fair value of the plan assets. So if we, to get that actual return, just like it shows here, we're taking plan assets, the ending balance minus the beginning balance. That gives us the change in plan assets over the course of the accounting period. And then we subtract out contributions that we made to it and then any benefits paid out of it to get our actual return. And again, depending on the market and depending on how the plan asset investments are doing, this can either have a positive or a negative effect on the pension expense. Amortization of prior service costs. So if we make any changes to the plan and we have to basically retroactively calculate benefits for employees, then this would increase the pension expense. So this one says plan amendments often include provisions to increase benefits for employee service provided in prior years. Company allocates the cost, the prior service cost, of providing these retroactive benefits to pension expense in the future, specifically to the remaining service years of the affected employees. And then finally, gains or losses. So volatility in pension expense can result from sudden and large changes in the fair value of plan assets and by changes in projected benefit obligation. And again, depending on whether it's a gain, which of course would be a increase, or a loss, which would be a decrease. Let's see, effect on the expense. So a gain, that confused me for a second. So if we have a gain, that can decrease the expense. If we have a loss, that can increase the expense. So anyway, we'll see some examples. We'll get practice with it like we always do. So here's an example of this pension worksheet that is used. And so just like it tells us in the book, this pension worksheet is not a an official general ledger account, we could think about this pension worksheet like an amortization schedule or a depreciation schedule, right? We can fill this out, and that tells us or gives us the information that we need to record our journal entries. And so that's what it's showing here. The general journal entry columns determine the journal entries to be recorded in the formal general ledger. And then the memo record columns maintain balances for the unrecognized pension items. And so based on this information, they're going to show us one of these pension worksheets filled out. So on January 1, 2017, Zarley Company provides the following information related to its pension plan for the year 2017. So plan assets as of January 1, 2017 are 100,000. Projected benefit obligation is 100,000. Annual service cost is 9,000. The settlement rate is 10%. Actual return on the plan assets is 10,000. Funding contributions are 8,000, and benefits paid to retirees during the year are 7,000. So we can use this information then to prepare the pension worksheet for 2017. And so you see that pension worksheet here, and you see the journal entry that we would use to record this. And so again, plan assets January 1, 2017 are 100,000. And here's that number right there. Those are our plan assets at the beginning of the year. Projected benefit obligation January 1, 2017 is 100,000. So, again, we can think about as of January 1, 2017, we were not overfunded or underfunded. We were funded right on the money, right? We had plan assets of 100,000 and projected benefits of 100,000, projected benefit obligation of 100,000. So again, as of the beginning of the year, we were not overfunded. We were not underfunded, right? We had exactly what we needed, basically. But now we've got these things happening through the year. So annual service cost is 9,000. So that is a debit to pension expense. This is a debit to pension expense, credit to the pension benefit obligation, which is, essentially how much we expect to owe, how much we're obligated basically to pay. Interest cost, that's our settlement rate. So it said our settlement rate is 10%. That's where we're getting this 10,000, right? 10% of 100,000, our interest cost. Actual return on the plan asset. So again, this is either from interest revenue or dividends, and I'll just write that here, either interest revenue or dividends that the plan asset, those investments are paying to us, right? And as you can see, when we have a return, that decreases our pension expense for the year, right? And then we have contributions that were made of 8,000. So that's a decrease to cash, as we can see here. And then finally, benefits paid to retirees during the year, 7,000. That's where we get a decrease in the assets, an increase in the obligation. So overall, the net effect of this is our journal entry. And so we see that journal entry here. We've got a debit to pension expense for 9,000, a credit to cash for 8,000 for the contributions we made, and then a credit to, in this case, the pension liability, right? If it was a debit, if we were excuse me, if we were debiting this, it would be a pension asset, but we're crediting this. So that's the pension liability, right? And so we see that here too. That's our net liability. At the end of the year, December 31, 2017, we've got plan assets of 111,000, but the projected benefit obligation is 112. So we are underfunded in this example by $1,000, right? Okay, not too bad though. I'm going to put some of these in Excel and we're going to get practice with them in class together. Okay, so amortization. So as we talked about a little bit already with the prior service cost, a company should not recognize the retroactive benefits as a pension expense in the year of the amendment, but rather should amortize them over the years of service, right? So employers should recognize the pension expense over the remaining service lives of the employees who are expected to benefit from the change in the plan. So two different amortization methods that this book talks about, the years of service method, or that this chapter talks about rather, the years of service method, and then straight line amortization. As it shows here, FASB or the board prefers a years of service method, but employers may also use the straight line amortization over the average remaining service life of the employees. Here's an example of that years of service. So basically what we're going to do with this, and it shows these examples, it talks about this on page 1129, but it says first, the company computes the total number of service years to be worked by all of the participating employees. Second, it divides the prior service cost by the total number of service years to obtain a cost per service year, the unit cost. Third, the company multiplies the number of service years consumed each year by the cost per service year to obtain the annual amortization charge. And so just like your book tells us, this is similar to the units of production depreciation method, but basically. So assume that Zarley Company's defined benefit pension plan covers 170 employees. In its negotiation with the employees, Zarley Company amends its pension plan on January 1, 2018, and grants 80,000 of prior service costs to its employees. The employees are grouped according to expected years of retirement as follows. So in Group A, we have 40 employees. They're expected to retire at the end of 2018. In Group B, we have 20 employees that are expected to retire in 2019. In Group C, we have 40 employees that are expected to retire in 2020. In Group D, we have 50 employees that are expected to retire in 2021. And then in Group E, we have 20 employees that are expected to retire in 2022. So basically what we look at is how we calculate the total service years is what we're looking at here. So we've got 40 employees that are retiring in 2018. So that's 40 service years. Then remember, we have 20 employees that are retiring in 2019. So they're going to work 20 years basically in 18. There's 20 of them. They're going to work 20 years in 2019. So that's 40 service years. Remember, in Group C, we had 40 employees that are going to retire in 2020. So they're going to work 40 years in 2018, 40 years in 2019, and then they retire in 2020. At the end of 2020, they're going to work 40 years in 2020. So that gives us 120 service years. Group D, remember, we expected 50 employees to retire in 2021. So they're going to work 50 years in 18, 50 years in 19, 50 years in 20. 50 years in 2021, they retire at the end of 2021. That's 200 service years. And then finally, Group E, these are the employees that are going to retire in 2022. So again, they're going to still work 20 years in 2018, 20 years in 2019, 20 years in 2020, 20 years in 2021, and then they'll work 20 years in 2022, and they'll retire at the end of 2022. And so that's 100 service years. So we add these together, plus equals 500 service years, right? And so now we're looking at that 80,000 divided by 500 service years, and we're going to get the cost per service year is 160. So the annual amount of amortization based on the $160 cost per service year is computed as follows. So in 2018, we've got 170 service years. We're multiplying by $160. So we're going to amortize $27,200 in 2018. 2019, we've got 130 service years times 160. We're going to amortize $20,800. 2020, we've got 110 service years. We're multiplying that by 160. We're going to amortize $17,600. So on and so forth until we've amortized that 80,000 prior service cost. All right, so now based on that prior service cost and that amortization amount, we're going to look at what our pension worksheet then would look like with this information included. And so it says, use the following defined benefit, defined pension data of Rydell Corporation, apply to the year 2017. So again, this is, and I was just trying to see here where it, that's the original pension worksheet. Maybe it doesn't actually show us this example in the book, but anyway, that's okay. So projected benefit obligation on January 1, 2017, before the amendment, 560,000. Plan assets, 1/1/2017, 546,200. Pension liability, 13,800. And so, you know, again, just so our brains are thinking this way, and it's making me wonder, is this actually one of our homework exercises? Is this actually exercise 20-7? I guess that'd be nice. That's one of your homework exercises out of the way, but let me just double check this because I did not look at that when, yeah, so this is actually exercise 20-7 out of your textbook. So this is actually one of your homework exercises. So then that's kind of nice. But, you know, again, basically, just so our brains are kind of thinking this way, our projected benefit obligation is 560,000, right? And our plan assets are 546,200. So, you know, as of January 1, 2017, we are underfunded 13,800, right? That's the liability. That's what we are underfunded by, okay? And then it says on January 1, 2017, Rydell Corp. Through plan amendment grants prior service benefits having a present value of 120,000. Settlement rate is 9%. Service costs 58,000. Contributions or funding to the plan is 65,000. Actual expected expected return on plan assets 52,280. Benefits paid to retiree 40,000. And then prior service cost amortization for 2017, 17,000. So instructions for 2017, prepare a pension worksheet for Rydell Corp. That shows the journal entry for pension expense. And so here's an example, and I'm just going to click through all of this so we can see kind of the bottom line numbers. And so remember that this plan had projected benefit obligation of 560,000, plan assets of 546,200, which gave us that underfunded liability of 13,800, right? That's where we started the year, okay? Now this plan, or excuse me, prior service cost, 120,000. We see that here. It said that on January 1, 2017, Rydell Corp. Through plan amendment grants prior service benefits having a present value of 120,000. So again, that increases our projected benefit obligation from 560 to now it's 680, right? Service cost, also, as we can see here, increase our projected benefit obligation, right? Interest cost also increase that projected benefit obligation. The return, remember, this is from any interest, revenue, or dividends on the, essentially we're going to have these plan assets invested in something, whether it's mutual funds or whatever, right? We're going to have them invested in something. And so this is going to be either for interest, revenue, or dividends, which decreases the annual pension expense, increases the plan assets. Amortization of the prior service cost. This increases our pension expense, decreases the other comprehensive income for those prior service costs. Contributions made by the company, of course, that decreases our cash, but that increases our plan assets. And then benefits paid out to retirees or to former employees. These decrease our projected benefit obligation, and then also decrease the plan assets, right? And so the journal entry to record the net effect of all of this, we see here, right? We would have a debit to the expense, credit to cash, debit to other comprehensive income, credit to the liability. And again, we see here the difference between the obligation and the plan assets. And so we are in fact still underfunded, but now we're underfunded by a total of 135,720, right? And so this is what that journal entry would look like. Again, debit to the pension expense, debit to the other comprehensive income for 103,000, credit to the pension liability. Since we're crediting it, it's credit to the liability, right? 121,920, and then a credit to cash for the 65,000. Okay, so gains and losses. So with gains and losses, we're also going to be looking at that comprehensive income account to record gains and losses. So gains and losses arise from unexpected swings in, oh, okay. I was like, where's the little chart that goes on there? Unexpected swings in pension expense, which can result from sudden and large changes in the fair value of the plan assets, or changes, or I should say, or changes in the actuarial assumptions that affect the amount of the projected benefit obligation. So, not only because we have these ups and downs in the market, but, changes in, for example, life expectancy rates, changes in the number of employees, changes in the expected retirement date of the employees or whatever, right? Different changes like that, right? The actuarial assumptions. And so what what FASB has done to kind of reduce some of these you know, swings, unexpected swings, just like it shows here. It says the profession decided to reduce the volatility with smoothing techniques. And so there are a few different smoothing techniques that the book discusses. And we're going to look at examples of these, but basically, we can smooth, for example, by determining what the expected return would be. We can smooth by amortizing the accumulated gain or loss, or we can smooth by spreading the excess over the remaining service life of the existing employee. So there's a few different ways that this can be smoothed out. You know, again, we'll see examples of it and get practice with it in class together. But smoothing unexpected gains and losses on plan assets. Companies include the expected return on the plan assets as a component of pension expense, not the actual return in a given year. So that's one way. I mentioned that companies can smooth these ups and downs. Companies record asset gains and losses in an account other comprehensive income for gains and losses, combining them with gains and losses accumulated in prior years. So that helps again to smooth out the ups and downs over the life of the pension obligation. Smoothing unexpected gains and losses on the pension liabilities. Again, companies report liability gains or liability losses and other comprehensive income. Companies combine the liability gains and losses in the same other comprehensive income account. They accumulate the asset and liability gains and losses in accumulated other comprehensive income and report on the balance sheet in the stockholders' equity section. Okay, so corridor amortization. So it talks about corridor amortization on page 1133 of your textbook. Basically, this is a high and a low, and anything in the middle is the corridor. Basically, I think the next slide shows us in a picture of this, but essentially, FASB invented the corridor approach for amortizing the accumulated net gain or loss balance when it gets too large. How large is too large? 10% of the larger of the beginning balances of the projected benefit obligation or the market related value of the plan asset. So whichever is larger, whether it's the projected benefit obligation or market related value of the plan assets, whichever is larger, we're going to multiply by 10% to get that top and bottom, basically, corridor. Any accumulated other comprehensive income net gain or loss balance above the 10% must be amortized. So it's showing us an example of those calculations here. I guess it's, yeah, the next slide actually shows us the corridor. So in 2016, the benefit obligation was $1 million. The market related asset value was 900,000. So we're going to use the larger of the two. We're going to multiply by 10%. So that's $100,000 corridor either way, right? Whether it's, more than 100,000 in gains or more than 100,000 in losses, we have to amortize it, basically. 2017 projected benefit obligation is 1.2 million. Market related asset value is 1.1 million. We're going to go with the larger of the two. So we're going to multiply the 1.2 million times 10%. That gives us the $120,000 corridor. Again, if gains or losses are greater than 120,000, then they have to be amortized, right? And so on and so forth. I'll go through one more of these. In 2018, the projected benefit obligation was 1.3 million. Market related asset value was 1.7 million. So we're going to use the 1.7 million to calculate the corridor. We multiply that by 10%. Again, that's 170,000 plus or minus. So whether we have either gains greater than 170,000 or losses greater than 170,000, we're going to have to amortize that if it doesn't fall within the corridor. So just like it shows here, the corridor becomes 10% of the larger of the projected benefit obligation or the market related plan asset value. Here's an example of what that corridor looks like. And so again, anything that falls outside of that has to be amortized, right? So the FASB set a limit of 10% of the larger of the beginning balance of the projected benefit obligation or the market related value of the plan assets above that size. So anything above here or below here, right? The accumulated other comprehensive income account related to gains and losses is considered too large and must be amortized. All right, so here's an example. It says Shin Corporation had a projected benefit obligation of 3.1 million of plan assets and 3.3 million, projected benefit obligation of 3.1 million and plan assets of 3.3 million at January 1, 2017. Shin also had net actuarial losses, 465,000 in accumulated other comprehensive income at January 1, 2017. The average remaining service period from Shin's employees is 7.5 years. Instructions compute Shin's minimum amortization of the actuarial loss. So projected benefit obligation, again, 3.1 million, plan assets, 3.3 million. So this is our first example where we're actually overfunded, right? We actually have more in the plan assets of our projected benefit obligation. So that's nice. And so we're going to take that 3.3 million times 10%. The corridor amount then is 330,000. Accumulated loss, 465,000. And so excess loss subject to amortization, 135,000. Average remaining service, this is in years, right? So 7.5 years. And so we're going to amortize 18,000 a year to the pension expense, essentially added to the pension expense. All right, reporting pension plans in the financial statement. So just like your book tells us, there are some things that need to be shown or reported within the financial statements, and there are some things that should be reported in notes or disclosures to the financial statement. So recognition of the net funded status of the plan. This is either the overfunded or underfunded status, which is measured as the difference between the fair value of the plan assets and the projected benefit obligation. Classification of pension asset or pension liability. Again, the excess of the fair value of the plan assets over the benefit obligation. Aggregation of pension plans. This one just says that all overfunded plans should be combined and shown as a pension asset on the balance sheet. Similarly, if the company has 2 or more underfunded plans, pension liabilities, the underfunded plans are combined and shown as one amount on the balance sheet. And then finally, actuarial gains or losses or prior service cost. These should be shown in the financial statements. And it talks about this on page 1139. It says, actuarial gains and losses not recognized as part of pension expense are recognized as increases and decreases in other comprehensive income. This same type of accounting is used for prior service costs. The board or FASB requires that the prior service cost arising in the year of the amendment, which increases the projected benefit obligation, be recognized in an offsetting debit to other comprehensive income. By recognizing both actuarial gains and losses and prior service cost as part of other comprehensive income, the board believes that the usefulness of financial statements is enhanced. And so again, they show us examples of this on page 1139, talk about this. Well, I should say 1138, 1139. All right, within the notes to financial statements, and we've got a few slides that talk about this, but within the notes, we should, number one, record major components or disclose major components of the pension expense. Number two, reconciliation showing how the projected benefit obligation and the fair value of the plan assets changed over the period. A disclosure, number three, a disclosure of the rates used in measuring the benefit amounts, discount rate, expected return on plan assets, rate of compensation. Number four, a table indicating the allocation of pension plan assets by category. So whether they're equity securities, debt securities, real estate investments, or other assets, and then showing the percentage of fair value to total plan assets. Number five, the expected benefit payments to be paid to current plan participants for each of the next 5 fiscal years and in the aggregate. So for each 5 years, so individually 5 years and the aggregate or the total for the 5 fiscal years thereafter. Also required is a disclosure of the company's best estimate of expected contributions to be paid to the plan during the next year. Number six, the nature and amount of changes in plan assets and benefit obligations recognized in net income and in other comprehensive income of each period. And then number seven, the accumulated amount of changes in plan assets and benefit obligations that have been recognized in other comprehensive income and that will be recycled into net income in future periods. And then lastly, number eight, the amount of estimated net actuarial gains and losses and prior service costs and credits that will be amortized from accumulated other comprehensive income into net income over the next fiscal year. All right, and then finally, a couple special issues that the book talks about when thinking about retirement obligations and pension obligations. So in the book, and it talks about this, page 1144, 1145, this one says that so it says a classic example of the unfortunate consequences of an underfunded pension plan is the 1963 shutdown of Studebaker automobile operations in South Bend, Indiana, in which 4,500 workers lost 85% of their vested benefits. As a result of some of these situations like this, the ERSA, or the Employer Retirement Income Security Act of 1974 was enacted. So the Pension Reform Act of 1974 created ERSA. And so for those of you that are in payroll, accounting for payroll right now, we've talked about ERSA before. Again, ERSA stands for the Employee Retirement Income Security Act. Oh, Security Act. Right? And so essentially what ERSA does is that in these situations where the company goes bankrupt or the company's you know, the company goes belly up or whatever, this helps to protect those employees and helps to provide benefits to those employees. And so it says the legislation affects virtually every private retirement plan in the United States. It attempts to safeguard employees' pension rights by mandating many pension plan requirements, including minimum funding, participation, and investing, right? And then pension terminations, again, you know, several companies, and I talked about this a little bit before, but several companies have terminated their pension plan that they had and switched over to, you know, because again, a pension plan or a defined benefit plan, the employer basically carries most of the risk, right? And so a lot of companies have switched over from traditional pension plans to 401k plans or 403b plans, where then it switches the risk to the employee essentially, right? And so I'm just trying to look and see and so again, it talks about this, you know, the accounting issue that arises from terminations is whether a company should recognize a gain when the pension plan assets revert back to the company, also called asset reversion transactions. In some cases, a company starts a new defined benefit plan after it eliminates the old one. So again, just some issues when terminating this plan. And so it says IRSA prevents companies from recapturing excess assets until they pay participants what is owed to them, and then they can terminate the plan. And again, so just some of those issues associated with plan termination. So hopefully this was helpful. And of course, when we meet in class, we're going to get some more practice with it. Hi again there, guys. Okay. And, you know, as always, once you have a chance to view this recorded lecture or read that chapter, just let me know if you have any questions, and I will see you guys in class. Bye-bye.